A brief intro. There are people here who are meeting me for the first time, so I thought I'll just spend a minute on that. So I'm Prabha Srinivasan. I'm a founder, CEO of Ventura Pranas. It is a cross-border advisory and compliance firm specializing in US and India tax and compliance and advisory. And we are a 100-member team, and we're located between Chennai, Los Angeles, Trichy, and Bangalore. I'm dual certified, and that was the genesis of the firm, and we've grown since our formation in 2011. These are all options that are very India specific. So I'm going to go over them with you, and not too much in detail, hopefully just enough for you to be educated enough to ask your advisor to say, does this apply to me? So Section 54 EC is basically, it allows you to reinvest capital gains that you generate out of a transaction into a certain specified investment. And in this case, the specified investment is a bond. And these are government bonds. It's either the National Highway Authority or the Rural Electrification bonds. So you've got to put you reinvest the capital gains, you don't have to pay the capital gains tax. The catch is you have to invest it and stay with it for about 5 years. The kind of property you should have sold should be either land, building, or both. And it should be a long-term asset. You already know that it's a 24-month wait period. It can't be a short-term asset. You can't use the rules in that case. So these are the overall limits, and you can put no more than 50 lakhs of your cap gains into it. Okay, so if your capital gains are 1 crore, you can only limit yourself to about 50 lakhs. If you happen to split that asset between you and your wife, you potentially both could use that exemption and get away without the tax, right? So that's a little bit about 54 EC. It's by far the easiest to comprehend. We go to 54, which applies to people who are selling real residential property. Okay, so you can sell a residential property and reinvest the cap gains into another residential property. It can be one or more. It can be more than one. It can be two, and you can't do this more than once in your lifetime. So keep that. You can't keep rolling around properties and expect that every time you do it, it is cap gains exempt. The catch is it's got a few more conditions. You've got a timeline, so which means, you know, if you're purchasing up to a year before or 2 years after, you should have purchased the replacement. If you're constructing, up to a year before or 3 years after, you should have finished construction. Okay. The other catch is you can't sell this property for about 3 years. You've got to hang on to it, and you can't do another deal within another year in another real estate property and expect to benefit from it. You will negate the benefits of this code section. Now, I have questions from my clients saying, can I sell in India and buy the residential property in the US? That is not why India enacts codes. It is to ensure that you reinvest and plow back your gains back into the Indian system. So the answer is no. Okay, so I think those broadly cover the points under Section 54. The catch is the same. I told you you've got to stay in the property for about 3 years, and so I'm going to leave it at that. We'll go in, and let's say, okay, so the due date by which you need to make this, you all know, right? You've got a 2-year window, 3-year window. But let's say the tax return time is coming along and you've not yet figured it out. You know, there are properties to see, you haven't wrapped your head around them. Well, you park it into a capital gains account scheme, and then you buy yourself some time. And then, you know, at the end of 2 years, hopefully you've done it. At the end of 3 years, hopefully you've constructed it. But if you haven't, then you pull those cap gains that you had deferred at that point and you offer it to tax in that particular year without penalties. Okay. So with that, we move on to Section 54F, which is basically any property, any long-term property except residential, which is why you have Section 54. So you could sell Indian stock in a closely held company. The hold period for it to be long-term is 2 years. You could sell Indian stock on a listed stock. The long-term period holding there is 12 months. You could sell foreign stock. You know, a lot of our clients have stocks in foreign companies, and they can generate long-term capital gains. So this is where India becomes selective, right? You can sell abroad, but please bring the capital back here. We're happy to get it. So for the hold period for that is 2 years. And lastly, you could be looking at the sale of any other property, you know, which could be land, right? So, and for that, the hold period is about 2 years. So these are the properties. The only difference between this section and the previous section I want to point out is here it is a factor of what percentage of reinvestment your capital that you infuse into the new property bears to your sale proceeds. It's not a factor of capital gains per se. You apply a ratio on your capital gains, and to that extent, you save on your cap gains. And the latest Finance Act has capped this. I've had clients who've made massive exits and put in 100 crores into a property. Here, they've actually come back and said the max you can do is up to 10 crores. So it's kind of, it does hit people quite hard. The conditions are very similar to the previous section. You've got 1 year before, 2 years after to purchase, or 1 year before and 3 years after to construct. And if you've not made up your mind by the time you've got to file your returns, you can park it in an account and say, I need time to work it out, so give me that time. So it's the same conditions. You've got to hold on to the asset for 3 years again. So you can't get in and change your mind. Okay, so everything I covered to you has already been covered. Keep in mind that if you park it in the capital gains account, you're generating income, interest, that is taxable. It is true of all sections. Okay, there's no escaping from the taxes on the income that you generate out of these deposits. There's a misnomer. A lot of people think that is also tax-free, and that is not. So I want to add a word of caution here. Okay, so these savings in tax are purely Indian. It does not mean you save US. You just saw in the example earlier how suddenly a huge tax bill in the US shrank from $65,000 to $11,000, right? It was because I was able to use the foreign tax credits from India. Now you do all this fancy planning, you might be extremely efficient in India, but what happens to the US bill? So it may not be a zero, all or none. It could be a delicate balance between the two, which is why you need to talk to your advisors. And if you know an approximate sale price, talk to us earlier so we're not scrambling towards the time of deal making, to get there. So let's switch gears now and talk about US, right? So I think the US regulations itself were built around the white picket fence dream. So they brought out this rule saying that if you own a property and it's your principal residence for 2 out of the last 5 years, you can exempt capital gains tax on the gains on the sale of the property up to $500,000 for a married filing joint couple, or $250K for a single filer or a married filing separate. That's pretty powerful, right? It's a huge tax savings. So I'm going to throw an example at you saying, let's say you lived in India, you're a citizen of the US, you lived in India, you made yourself a home here, and you decide to move back to the US, and you're now looking to sell that property. Keep this window in mind. If you're able to fulfill that 2 out of 5 rule, you've used the property as your principal residence, you may want to invoke this to checkmate the Section 54 regulations on the India side so that you actually accomplish tax savings on both ends and you're not getting killed on the other, right? So this is pretty important to keep in mind. Most states are federal compliant, so I would say you would solve for the state issue as well. Take an example of somebody who moves away from India, again, similar example, decides to move into California. Moves early in the year, he's subject to taxes on worldwide income, but the fact that he's able to avail this exemption will get him relief even in California. Okay, so it is a pretty effective way of figuring out how to use these 2 rules on both sides. Section 1031 exchange, I get this question a lot saying, can I sell in India and buy in the US? Again, the answer is no. Nobody is wanting you to give you tax breaks in India to go and invest in a foreign country. It has to be similarly, US says if you sell in India, don't come and invest it here and take the tax break. Invest it in India. At least they're a little bit considerate than the Indian rules, right? So they let you buy and sell in India. The catch is that it has to be investment property. It can't be a primary. And 2, I talked a little bit about this 1 year, 3 year window during which you can buy or construct from an Indian standpoint, but from the US, they only give you 6 months, okay? So you've got 6 months to figure this deal out, and you can't have any cash generated in the transaction, otherwise it creates taxability. So you've got to work with the tighter US rules when you're trying to navigate the regs from both sides, okay? So the answer is yes, if you're using Section 54B in 54 in India, maybe you can look at Section 1031 in the US and see if there is a balance you can strike between the 2, keeping in mind that there are title rules, duration rules on the US side. So that's it.